Good evening. This is Jackie Knight. I'm the Corporate Training Director with STC, and I'm glad to have you join me this evening for our webinar on some advanced insights into self-directed retirement accounts. First, before we begin, I do need to make a couple of comments about STC. We are a retirement plan administrator. We do not provide legal, tax, or investment advice to our clients. We also don't represent or sell any securities or investments of any kind. We are not a registered investment advisor, nor do we represent or endorse any investment opportunities. And I may talk about some during this webinar, but we don't actually represent those opportunities. We do recommend that you consult with your legal, tax, and investment advisors prior to making any investments. This evening's webinar is going to cover some basic information about self-directed retirement accounts. I'm going to walk through some specifics related to particular types of accounts. We're going to talk a bit about Roth conversions. That can be a very popular topic with some folks. And then we're going to discuss non-recourse loans in some detail. If I have any real estate investors in the audience, which I usually do, this is a topic that might be of particular interest to you. We are also going to cover UBIT and UDFI, which I will define. And then we're going to talk about the particular type of account setup that STC does for our clients, why we do that, and how that can benefit you. And then I'll also detail all of our particular services. And at that point, I will open the floor for your questions. So let's get started first with a basic definition of what is a self-directed retirement plan, because I have spoken to many people who think they have a self-directed plan when they can pick and choose from some particular types of assets. However, a truly self-directed retirement plan means that you can choose any type of asset that is permitted by law, that's allowable under the regulations. So this does include what some consider non-traditional assets, like real estate. We often have individuals come to us who are interested in investing in real estate in their retirement accounts. Not all companies will permit you to hold that type of an asset in a retirement account in their firm. Self-direction also means that you are making the decisions that relate to the investments. You're going to manage those investments. So, for example, if you do decide to purchase a piece of real estate, you will decide if you are going to perhaps renovate that property and rent it. If you are, what the rental rate will be. Down the road, you might decide that you want to sell that property. You're going to decide the sales price. So you're basically going to make the decisions that relate to the investments in your retirement account in a self-directed account, meaning you have more control. Now, why should you even consider self-direction? It's a lot simpler just to put your money someplace and maybe just pick and choose from assets that the company permits you to hold. Here are some of the reasons that people consider self-direction. Number one, and this is big. Most financial planners will tell you that you really do want to diversify your holdings, your assets, and with a self-directed account, you can truly diversify into asset classes that are unrelated or not correlated to each other. So in this case, you can include non-traditional assets. I mentioned real estate. You can also invest in mortgages and notes. You can actually invest in private businesses. And in addition, of course, you're going to choose and control those investments and transactions. I mentioned that. And then an item that's pretty significant, especially for real estate investors, is that you can use leverage in your retirement account to purchase an asset. So you can actually increase the buying power of the dollars that you have in your account by using leverage, getting a loan. Now, that loan in this situation must be a non-recourse loan. We're going to talk more about that on a future slide, but you certainly can use leverage to purchase a piece of real estate in your retirement account. Let's take a quick look through different types of retirement plans, just a little bit of information about them. Traditional IRA and Roth IRAs. These are pretty common to most people. Most people have an idea of what they are. You make contributions from your you can make contributions from your earned income each year. A traditional IRA, a Roth IRA, they have the same annual contribution limit. And for 2023, that is $6,500 from your earned income. You can contribute into either a traditional or a Roth IRA. If you're 50 years or older, you can do a catch-up contribution of an additional $1,000. So that would be $7,500. So what's the difference between these two? It is a big difference. It's a significant difference. Contributions into a traditional IRA are made pre-tax, like most retirement contributions. That means you don't have to pay tax on the amount you put into the retirement account in the year that you do that. Instead, when you begin taking qualified distributions, once you reach retirement age, 59 and a half, defined by law, then those contributions are included in your taxable income that year and at your current taxable rate. A Roth is different. Roth contributions are made post-tax, so you don't get to deduct them from your taxable income on your current year, the year you make that contribution. However, those monies in your Roth account, hopefully you invest them, they grow. When you do begin taking contributions, those qualified distributions are not included in your taxable income. So what that means is a Roth IRA does give you the opportunity for some tax-free earnings, not something we hear much about these days. So if you are interested in a Roth, that might be something that you want to look at with your tax accountant. A SEP is a simplified employee pension plan. This can be used by sole proprietors. I actually have one. It can also be used by small business owners or business owners. There's two different kinds of contributions. The owner and the employee can make contributions. The maximum contribution for a SEP for 2023 is $66,000. So this is you're making a contribution from the earnings of the business that the SEP plan is on. So if you have a business, you might want to look into this type of a plan. A simple plan, savings incentive match plan, smaller contributions, some different requirements than a SEP. I know of a couple of partnerships that use this. I also know of a sole proprietor who uses this type of plan. The contribution allowances for 2023 are $15,500. You can do a catch-up contribution if you're 50 or older for a maximum of $19,000. So check with your tax accountant if you're trying to determine what type of plan might work best for you. Now, out on your screen, you now see 4 types of plans that say former employer. If you formerly worked and participated in one of these types of plans, 401k, that's a for-profit corporate type of plan. 403b, often used by charitable organizations or nonprofits. A TSA is a tax-sheltered annuity. TSP, thrift savings plan. Some federal employees have that type of a plan. If you formerly worked and participated in one of these types of plans, then you are eligible to move the money out of that plan into a plan that you currently qualify for, say a traditional IRA, or if you have a SEP, into a SEP. So if you are currently employed and participating, then you will need to go to your corporate plan administrator or the nonprofit plan administrator and determine if you're eligible, if you'd like to move monies out into a type of plan that you can then self-direct. So formerly employed, you can move the money. Currently employed, you need to check with the plan administrator. And the last type of plan I do want to mention, it's newer, but it's been around for quite a while. We call it a solo 401k. Some people call it a uni 401k, different names. But basically, it is a 401k plan for a sole proprietor, for individuals who are in business by themselves for themselves. Now, they could have a spouse in the business with them, and very, very limited employees. It's basically for a sole proprietor, but it gives you the opportunity to save with both corporate and employer and employee contributions at a much higher level. It also has some nice provisions that business owners like. You can set up a Roth provision in a solo 401k so that your employee contributions are post-tax, but again, they have that tax-free earning potential opportunity. It also can be set up with a loan provision, and many times sole proprietors like that feature. This loan provision, really the loan can be used for anything. It doesn't have to be for business purposes, as long as it is paid back according to the terms set up in the documents and with the interest that's set up. It can be used for any purpose. So some features that sole proprietors often appreciate. If you are interested in a solo 401k plan, I will mention this. If you don't currently have one set up, you do need to have it set up by December 31st of the calendar year in which you'd like to make contribution from your business earnings. So for 2023 contributions from your business, you do need to have that set up by December 31st. It does take a bit of time to get the plan document set up. So if you are interested, you do want to start moving on that now. We're in the middle of October. End of the year is going to be here soon. So these are different types of plans. You can self-direct these types of plans when you're working with a self-directed administrator. Now, I do want to talk about some account specifics because some people have plans and they're not sure what they can do with them. So I want to talk a little bit about rollover, portability, and consolidation. So what I mean by portability, let's say you currently have a traditional IRA. You have a business. You decide that you want to set up a SEP plan on your business so that you can make larger contributions from your business earnings. You can actually roll over your IRA monies into that SEP account. That'll give you a bigger pot, then you can start investing in whatever you like. And the reverse is true also. If you currently have a business plan, a SEP plan set up on your business, you can move those monies to an IRA. They are like-kind accounts. Now, this next line is showing you that you can move IRA, SEP, and Simple Plan money to a Roth account. But you'll notice I have an asterisk there, and I do because you'll remember that I said Roth contributions were post-tax. So if you are going to move money from a pre-tax type of account, which is what an IRA, a SEP, and a Simple are, to a Roth account, then there are going to be tax consequences. You're going to need to pay taxes on the monies that you convert to a Roth. And we can talk a little bit more about that if people have questions like, okay, how are the taxes, what are they calculated on? But that would be something that you would want to consider if you want to move monies into a Roth account. There will be a tax consequence. Contribution limits and RMD. RMD stands for Required Minimum Distribution. I've already mentioned that traditional and Roth accounts both have $6,500 contributions from earned incomes annually for 2023, additional $1,000 catch up to $7,500. With a SEP, that maximum is $66,000. So depending on how your business is set up for the SEP, if you are a W-2 employee, then you can contribute 25% of your W-2 income into the SEP. If you're a sole proprietor and you are filling out a Schedule C on your tax return, that'd be a sole proprietor, then it's 20% of self-employed income. So your tax preparer can help you determine how much you would be able to contribute to a SEP. Simple, $15,500, I mentioned. Catch-up brings you up to $19,000. And required minimum distribution. The age limit at which you must begin taking distributions from certain types of accounts has been raised to 73 for 2023. So if you have reached the age of 73 and you have an IRA, then you must begin taking required minimum distributions. Same with a SEP. So those required minimum distributions are calculated based on your year-end value of your account, all of them required, combined together if you have multiple accounts, and then a percentage is applied to that. The IRS publishes this information each year, and so your tax preparer can tell you what you are required to take as a distribution, and then that distribution will be included in your taxable income. You will notice that this says there is no RMD for Roth accounts. There is no required minimum distribution. So your Roth accounts don't have that requirement. You're not required to take the distribution. Those monies would not have been included, if they're qualified, would not have been included in your taxable income anyway. With simple, I should mention, with simple IRAs, you do have a 2-year period after beginning participation. If you take distributions before that, you might have an additional tax. Let's see, anything else I need to tell you there? I think that's pretty much it. Oh, I should mention too that Roth do have a 60-month, 5-year requirement before you can take qualified distributions. So you can't open a Roth this year, contribute to it, and then begin taking distributions next year tax-free. There is a waiting period. Now, a few more account specifics. If you take an early distribution, there can be penalties. Payments that you receive before age 59 and a half, there are a few exceptions, so I won't go through all of those, but generally, payments that you receive before the age of 59 and a half are considered early distributions, and they will usually be subject to an additional tax of 10%. They must be reported to the IRS, and any amount, let's talk specifically now about a Roth account, any amount of an early Roth distribution, so before that, before you reach this age or before it has reached its 5-year length of existence, then any amount that's attributable to contributions is not taxed because you paid taxes on the contributions. So this will be some record keeping that's required. What did you contribute and what has been earned? They will be kept track of separately. Let's talk a little bit more about Roth accounts specifically, since these are a tax-free earning opportunity. So some advantages, obviously that tax-free growth. Qualified distributions are not taxed and there's no required minimum distribution. There is that 5-year holding period for tax-free distributions. Now, you can make conversions. I've mentioned that. Every conversion that you make has its own 5-year holding period. So let me just give you an example. Let's say you have $100,000 in a traditional IRA. You want to move it to Roth IRA, but you don't want to bear the tax burden of converting all $100,000 to a Roth in a single year. So what you decide to do is convert over the next 5 years, $20,000 each year. So the first year you convert $20,000 to a Roth and you pay taxes on that. The second year you do an additional $20,000 and so on. What I want you to understand is if you do that, each of those conversions starts its own 5-year holding period. So just something to keep in mind. If you're thinking about conversions, you want to talk with your tax accountant about that and talk about how you want to make that work for the monies that you have, the taxes that you're willing and able to pay, and when you're going to be able to take those monies tax-free. Income limitations. There are some income limitations on who can open a Roth account and make contributions. However, there is a bit of a workaround for that. You can actually make a contribution into a traditional IRA, and then do a conversion. So you, whatever your situation is, make the contribution into your traditional. Again, you didn't pay taxes on that, then convert it, then pay taxes on the conversion to get it into a Roth account. And if you need some assistance with that, we can help. We help our clients with that kind of a transaction. Now, let's talk specifically about conversions. There will be taxes due and payable, and they must be paid for from the converted account. You can't pay those taxes from your personal money outside of your retirement plan. That would be considered a prohibited transaction. So if you are going to do a conversion, you do want to make sure that you can pay the taxes on that conversion from the monies in the account. If you have multiple accounts, I mean, you can do whatever kind of conversion you want. You could combine multiple accounts into a single Roth. You can also do partial account conversions. Just like I mentioned, the one, if you have 100,000, you don't want to do it all at once. You can do it partially. So you do have some flexibility to get funds into a Roth account. And I'll just say there may be some great tax benefits down the road if you have some investment opportunities that you feel are really going to give you good returns. And a tax-free return is always the best return. So that's a little bit about Roth accounts and conversions. And we do advise you to check with your accountant for all the specifics on that. Let's talk a little bit now about non-recourse loans. I mentioned that we often have real estate investors come to us because they're interested in owning real estate assets in their retirement account. There may be cases where your retirement account has insufficient funds to wholly cover the cost of a real estate investment. And so your retirement account can get a non-recourse loan. So what is a non-recourse loan? Basically, it simply means that the security instruments, the notes, the mortgages, they allow no recourse against the individual account holder, you, the owner, or the balance in your retirement account if there's a default on the loan. The only recourse is the property itself. So it is much more similar to a business loan. Just very different requirements from a personally guaranteed loan. So let's talk a little bit about what that means. First off, your retirement account is not a person. It doesn't have a job. So for a non-recourse loan, there's no income or employment verification. It is not you getting the loan. It is your retirement account. Let's talk a little bit about general industry standards. Now, you can go out to the internet and you can search for non-recourse lenders and talk with them about their particular terms and such. So what I'm going to tell you here are general requirements. You will need to find the specific requirements from the particular lender related to the particular investment that you're looking at. Generally, the required documentation, they are going to need to see a loan application. They're going to want to see the purchase and sale contract of the property that you want the loan for. They're also going to want to see your IRA statement or a statement of your retirement account. They will require an appraisal of the property. And if it is a rental property, they will want to see a rent roll. They're going to want to see what the rentals have been in the past. So those are some of the required documentation. Loan guidelines. The maximum loan to value is probably going to be 70%. So it is going to require a larger down payment than a personally guaranteed loan, 30% or more. Terms, we've seen 20 to 30-year terms. We've also seen adjustable rate mortgages, 3-1, 5-1, 7-1. Again, it will depend on your lender. They will also be looking for an income to expense ratio likely of 1.25 or higher. And another requirement that I think all of them will require is they will require you to keep some reserves in your retirement account. Could be anywhere 3 to 6 months reserves, meaning possible expenses that the property may incur. Let me explain what that is and why. So let's say you are getting a loan for a property. You're buying a single-family home in a college town near the campus. You're going to renovate it and parcel it up and rent it to college students. Okay, that property is going to have some expenses that just by nature of being real estate go along with it. There'll be real estate taxes. There could be a repair required. Something could happen with the plumbing. You might need to fix the water heater. You might need to put on a new roof. So just looking at perhaps the age of the property, the state of repair that it's in, the lender is going to require you to keep some cash monies or very liquid funds in your retirement account should some of those expenses come up. We know real estate taxes are going to come up. So the lender is going to require you to keep some reserves. And that's because you can't fund those expenses yourself because it's your retirement account that owns that property. And you may or may not be eligible to put more money into your account. Let's say for this year, you've already made your contribution. You've already done your maximum annual contribution. You can't put any more money into the account. And now a bill comes up or you got to put on a new roof. So that is why lenders require some reserves in your retirement account to be held in order for them to lend to you. Now, eligible and ineligible properties. A wide range of eligible properties, single-family residences, absolutely, some condos, like small 2 to 4 plexes, so duplexes up to small buildings, multifamily, so a small apartment building, retail, office, warehouse, all of those are eligible for non-recourse loans. Ineligible properties generally include mobile homes. Personally, I don't know any lender that will give you a non-recourse loan on a mobile home. Timeshares, condo hotels, certain restaurants, that will be dependent on the lender, and residences with 5 or more acres and farms. Those are generally ineligible properties. Again, you will want to talk specifically with the lender that you are considering and talk about the particular property that you are looking at to determine what they require and what they will lend on and what they won't. So that's a little bit about non-recourse loans. Now I want to take that topic a little bit further. You can see I've got some acronyms up there, UBTI and UBIT. UBTI stands for Unrelated Business Taxable Income. This is a defined type of income that the IRS has determined is taxable. There are charitable organizations that are tax exempt, but if they engage in a business, they do something not related to their tax exempt purpose that earns them money, the IRS has decided that they should pay taxes on that. So, because they have an advantage, otherwise they have an advantage over those who have to pay taxes, for-profit organizations. So the IRS has decided that that is also going to apply to retirement accounts. Retirement accounts have a tax-exempt status, at least for a time period. Now, in most cases, the income that your retirement account generates is tax deferred or tax free if it's a Roth account. But again, there could be a case where it is taxable. Now, UBIT stands for Unrelated Business Income Tax. So this is now the tax on that income that was earned that was unrelated to your nonprofit, your charitable status. Typically, IRA investments generate passive income. Let's talk a little bit about real estate investments. If you are a real estate investor and you are doing real estate investing in your retirement account. If you do it, if let's say you do 20 real estate transactions in a year in your retirement account, the IRS might look at that as operating a business within your retirement account, and that could potentially trigger UBTI and UBIT. So we do have many clients who do real estate transactions, and we just recommend to them that they limit the number that they do so it is not seen by the IRS as a business. You, of course, can talk with your tax accountant and decide what you want to do because, again, you do truly self-direct your account with STC. We will just give you our best advice based on what we think the IRS, how they might look at your account. Now, there is another type of, so typically the sale of real estate will be considered passive as long as the intention was to purchase for appreciation or long-term gain. But back to if it looks like you are actively investing, the IRS could look at that differently. Now let's talk a little bit about, aside from the real estate investing, about getting a loan, getting a non-recourse loan to purchase a property. There is a subset of UBIT called UDFI, and that stands for Unrelated Debt Financed Income. Now, this is a subset, and a subset of UBIT, and it applies to any income that is generated from an asset that is purchased using financing inside of this retirement account. So let's just talk about an example. Let's say you want to purchase that house in the college town and you need to get a loan. Your retirement account does not have sufficient funds to wholly pay for it. So let's just say you're going to get a loan for 50% of the cost. Then that means 50% of that property is debt financed. 50% of it was because of leverage, but you were able to purchase it. Now, UDFI is based on the net income of the property. So that means as this property is generating income, say the rentals that you receive each month from the college students, less all of the expenses related to that property, will give you the net income. So your revenues minus your expenses will bring you down to your net income, and that is what is going to be looked at for this UDFI. The first $1,000 of that net income is exempt from the tax. And the percentage of taxable income is based on the ratio of debt on the property. So back to that example, I said you got a loan for 50% of the purchase price of the property. Then that means that only 50% of the net income is going to be subject to this tax. Now, when the asset is sold, if you have had any outstanding debt in the past 12 months prior to sale, then the gain can also be subject to UDFI if there's a gain on this sale. So some things to think about. What I want to talk with you about is I've talked with some folks and they're like, nope, I'm just not going to do it because I can't fully finance it. I don't want any taxes. I don't have to pay any taxes in my retirement account. And I understand that, but you might want to also consider the value of working through how the figures might actually turn out for you. So this is an example. This is that rental investment I talked about. It is 50% debt financed, and this particular property is giving you an annual net rental income of $12,000. This is net, this is after your expenses. You're making $1,000 a month clear. Okay, now we said the income that will be subject to UDFI on that $12,000 is only $5,000. Remember, the property is 50% debt financed, so only 50% of the net income is subject to this tax. 50% of $12,000 is $6,000. And then I said the first $1,000 is tax exempt. So $6,000 minus $1,000 brings us down to $5,000. That's the amount of your net income that's subject to UDFI. Now, UDFI, the IRS has decided it is taxable at the trust tax rate. And for 2023, it is a graduated tax. It ranges from 10 to 37%. So I actually did the calculation for this example, and your taxes for this particular example would be $794. So your net income after those taxes is $11,206. So the question to ask yourself if you're looking at an investment like this is, am I willing to pay $794 to be able to debt finance this property and earn $11,206? So just something to think about. Sometimes, it might be beneficial, even though your retirement account has to pay some taxes, in order to be able to own the investment. So just something else to think about. That is unrelated debt finance income. It is, again, taxable at the trust tax rate. It is reported on IRS Form 990-T, and the tax must be paid from the retirement account. Remember, it's the retirement account that earns that money, and you have $12,000 in there to pay the taxes. So you have net income, you have cash in the account. So the tax does need to be paid from the retirement account. And as always, discuss that with your tax advisor. I want to talk a little bit now about the setup that STC uses for each of our clients and why we do it. We actually set up for each client account an LLC structure, and that LLC becomes the investing vehicle or the investing entity for the account. And we do this for a number of reasons. One, it gives you a great deal of flexibility in structuring transactions, transactions that use debt, that have multiple parties, transactions that you might have several different types of real estate with different parties to them. It just gives you a lot of flexibility when you use this LLC structure as opposed to just a straight retirement account. It does give you an additional layer of asset protection. It is an LLC, a limited liability company, but it is a very specialized one. So it's not a generic business LLC. Its operating agreement, its articles of incorporation have been written so that they comply with rules, and it's designed to be owned by a retirement account. So it's a very specialized LLC that we set up for you. It does give you checkbook control over your retirement account funds. Now, we know in the investing world, some investments can come and go very quickly, and you need to be able to move on them quickly. So we want to give you quick access to your funds. Now, you'll notice I have checkbook control in quotes, and that is because we don't actually give the checkbook to the client. Some companies do that. And if you're well versed in the rules and all the regulations and are competent not to engage in a prohibited, disqualified transaction, maybe that would be a good for you. But most people don't know all of the IRS and ERISA rules. So checkbook control means that we look over your transaction for you. We look at how the documents are titled, how the transaction is structured, who the parties are, who the seller is, who are the buyers, if there are more than one buyer. And our client services department reviews all of that to make sure that you are not violating any of the prohibited transaction rules, which can get you into hot water with the IRS. And then we can same day or next business day fund that transaction. So it's basically protected checkbook control. You have our experts looking over your transaction. If you do engage in a prohibited transaction, the penalties can be very severe, up to forfeiting your retirement account. I've read some kind of horror stories of people who did that, and the IRS claimed that their whole retirement account was no longer tax deferred eligible and became immediately taxable to them. So it is something that you want to be careful of, and that's part of what we offer our clients. And as I mentioned, immediate same day or next business day, we can fund your transactions once we've looked over them and seen that they comply. Using this structure also simplifies asset titling. For example, in a real estate transaction, you are one of the co-managers of this LLC. You're the investment co-manager. You actually go to closing on behalf of your retirement account, and you can sign the closing documents. So it will make it easy for you to close on closing. Companies that don't offer this may require you to send the closing documents to their office, where they await someone's review and approval. So something to think about. You can actually go to closing when you have this type of an account with us, and it does ease pooling or partnering with other entities. So let's talk a little bit about who you could partner with in a transaction. Now, if you have done any research or heard anything about disqualified persons related to your retirement account, you will know that you yourself and your spouse and certain family members are disqualified persons to your retirement account and cannot do direct transactions with your retirement account. However, you can partner with yourself, your own personal investment funds, your spouse's retirement account, and family members, as long as you do that partnership at the inception of the purchase transaction. And we can help you structure that properly so that it is a permissible transaction. So your retirement account does not have to fully fund the purchase of an investment. You can be co-owner. Your retirement account can be a co-owner with others. You can also invest with colleagues, LLCs, investment syndications. So you have a number of opportunities for partnering with other sources of funds. Now, this is a schematic of our retirement plan structure. We'll start up here in the upper left. This would be your current custodian. If you have a current plan, you decide you want to work with STC, so you would complete some documents that would direct the transfer or rollover to our self-directed custodian. We will create the LLC in the state of your choice that is going to be owned by your retirement account. And once that setup is complete and the funds have moved to a bank account that your LLC has access to, you'll be ready to invest. So in this case, your retirement account has invested in a tax lien, in gold bullion, and you wholly own those in your retirement account. But investment number 3 has 4 owners, your retirement being one of the 4. This is a foreclosed real estate property. And you also invested your retirement account with your father, with your daughter, and some of your personal funds. Those 3 parties in yellow would normally be disqualified. However, if you if you co-invest at the inception of the purchase transaction, then this is a viable, allowable transaction. And we would be happy to help you understand that and accomplish that if you wish in your retirement account. Let me quickly review our full service approach to administering your retirement account. We set up that retirement account LLC structure. We have CPAs and attorneys available to answer technical questions you may have. We offer unlimited guidance on transaction compliance. We handle all the back office support, maintain LLC financial statements. We supervise the regulatory reporting that is required, and we oversee the annual valuation and the reports going to the IRS. So we will really do all of the administrative support for your retirement account and let you focus on doing what you do, which is finding the best investments for your retirement account. So how can we serve you? You may know that you want to open a self-directed account. That's great. We can help you get started. You may have clients or colleagues who'd be interested in self-direction, and we'd be happy to send them information or invite them to a future educational webinar. Or you may simply need more information. Oh, pardon me. Let me bring that back up for you so you can see our contact information. Here's our website. There's a great deal of information there for you. Our corporate office number is available, and there's my direct email. You can always get in touch with me via email and ask questions, and I'd be happy to get back to you. So I do want to take a moment and open the floor for questions. I did get a few in advance, and it looks like I have about 10 minutes here. So if you did come up with a question and you typed it in, I'm going to open up my box right now, and I see a few there. And if something has come to your mind, feel free to type that in. And let me pull out the ones that I got. Okay. Okay, if I want to purchase a bank-owned house, okay, so this sounds like they foreclosed and the bank has taken ownership back. They often require verification funds. How would I verify funds that are in my self-directed IRA? We can do that for you. So as our client, we can prepare a verification of funds letter for you, and you can tell us the dollar amount that you want us to put in that letter up to the total value of your account. You may or may not want whomever you are verifying these funds for to know how much money you have. So you can tell us the amount you want in that verification letter up to the value of your account, and we can send that to you so that you can distribute that to whom you wish. Do I have to have earned income in order to contribute to my IRA? Yes, you do. Now, and then there's a second part. Does money earned from rental income qualify? It actually does not. Rental income is considered passive income, so that would not qualify as earned income that you could make a contribution from. So I got a little list here. I can tell you what is earned income. Wages, salaries, tips, other taxable employee pay, union strike benefits are considered earned income, long-term disabilities that you get prior to retirement age, and net earnings from self-employment. So if you have your own business, you own or operate a business or a farm, that can qualify. You're a minister or a member of a religious order. There are some special rules, but that can also qualify. Things that are not earned income: interest, dividends, retirement income, Social Security, unemployment benefits, alimony, child support. Those are not considered earned income, so you can't make contributions from those amounts. I'm just reading here. Can I provide startup capital for a new business, such as a retail clothing operation or an auto repair shop? Yes, you can. What you would need to check into is whether or not UBITs would come into play. So that would be a question for your tax accountant, unrelated business income. Depending on how you invest and what your return, how you're going to get your returns, UBIT could come into play in that case. But it should be, as long as there are no disqualified persons, operating in those businesses. And of course, you can't work for the business. It has to be an investment, not anything that you're going to actively participate in. If I want to put IRA money into a self-managed stock brokerage account, can I actively trade in that account with IRA funds? Yes, actually, we do have clients who do that, especially when they're between investments. Perhaps they had an investment and then they sold it, and now they have a large pile of cash in their account. They're earning very little interest, an escrow interest rate. So they want to actively invest that while they're looking for their next big investment. So what you can do, you do have to open it as a business brokerage account, and it must be opened in the name of your IRA LLC, and our client services department can help you know exactly how to do that. And then the monies will flow into that account from your retirement account at STC into that account. You can't put money directly in personally or take money out of that account. It has to flow through your retirement account, but you can operate it and you can make trades and buys and sells and, you know, liquidate whenever you're ready to, you find the next asset that you want to invest in. So yes, you absolutely can do that, and we can help you make sure that you get that set up correctly. One thing we do ask is if you do that kind of thing, that you do send us copies of the monthly statements, just so that we can confirm that you're not making any putting any money in and taking any money out of the account. We can track those things for you. Let's see, I did have a couple more questions. Okay. Can you purchase additional interest in a property you are already invested in? Okay, now I'm not sure how this this sounds to me like you're personally invested in a property and now you want your retirement account to invest in it. That would be a no. If you're personally invested in it, then that would be a prohibited transaction, because your retirement account would be investing with a disqualified person. Now, this question could be read another way. If your retirement account already has an investment in a property, say it's a syndication, and now you have an opportunity to purchase additional shares in that syndication, that could possibly be a yes, as long as disqualified persons hadn't partnered with you in that investment. If you ever do a transaction where you have multiple parties and some of those parties are otherwise disqualified, ascendants, descendants, spouse, then those ownership percentages can never change over the life of the investment. So an additional investment would change the ownership position, so that then would not be allowed. So in a complex transaction like that, you just talk with client services before you do that, and we can help make sure that it's A-okay or a no-go, whichever is appropriate. And I think I did have a couple others. Let's see. Okay, I would like details regarding management of property held within an IRA. Can I handle the checkbook? Do I need a management company? We would say you should not handle the checkbook, because then you are directly involved with an investment owned by your retirement account. So generally, we suggest that you use a property management company, because you do want to make sure that you don't violate those disqualified person prohibited transaction rules. And our client services department can talk with you about the best way to make sure that you can have a reasonable, good flow of information and monies and expenses paid without violating those rules. Okay. A traditional IRA requires the owner to begin withdrawals at age, now it's 73, it was 72. That's the requirement minimum distribution. If one owns real estate in their account, are they required to sell it at some point in time in order to take that distribution? If income from the property exceeds the allowable contribution, how is that handled? Okay, I'm going to start with the first question. Okay, if you have reached the age of 73 and you've been informed that you must take a required minimum distribution, and all of your money is in property, so you don't have any cash to take out, you are not required to sell that property. But what you would need to do, if you don't want to sell the property, is you would need to have it appraised, and then you could take a portion ownership of that as your required minimum distribution. You would have the property retitled, and now it would be titled in your retirement account's name and your name, pro rata, and whatever portion you took. So you can take a required minimum distribution in property. It doesn't have to be in cash. Now, the second part of this question is going to be my last question. It looks like my time is about up. If income from the property exceeds the allowable contribution, how is that handled? Okay, there's a misunderstanding here. Your investments can earn as much as they can earn. There's no limit on how much you can earn on your investments. The limit is how much you can contribute from your annual earnings each year. So you are limited in your contribution. You're not limited in your earnings. So you can earn as much, and we hope you earn lots and lots in your retirement account. All right, well, those are going to be the questions for tonight's webinar. If you do think of things afterwards, please do email me. I'd be happy to get in touch with you. If you have questions, would like to open an account, we'd be happy to help you with that. We do appreciate your interest and hope you may be on our next educational webinar. Thank you so much for joining me this evening. Good night.